Hello, Matthew Copley here with Copley Financial Group, and we're going to do a market update today. It's been a while since I've done one, and obviously a lot has changed since the last one with the election and everything else that's going on. I'm going to be covering a lot of topics like the data that we're seeing in the economy. We're going to talk about the Trump election and what the impact of that is and what investments we're looking at now because of that. I'm also going to be covering a lot of investments that are available right now. For example, the 5.25% MIGA is still available, even though we thought it might end with the election. It is still out there. I don't know for how long, but if you are interested in that, we will have a link down below that you can click on if you didn't see the previous video. And also we're going to cover what we see going forward with the economy and the markets. In the last video, I mentioned the cost of living adjustment, what we expected that to be, and it came in exactly as expected on the low end, 2.5%. So everyone's Social Security checks, everyone's pensions, the official inflation rate for January 2025 is going to be 2.5%. I know a lot of you are saying, wait a minute, I shop at the grocery store, inflation's a lot higher. Well, the official inflation rate is 2.5%. What the government does is they have a lot of adjustments, hedonics, substitutions, different things they do to make this number look smaller than it actually is, but at least it is something. And so 2.5% is not too bad. Considering what we've seen over the last few years. I mean, obviously we got 8.7% in 2023. We got a 5.9% in 2022, 3.2% last year. So 2.5% come January, which will impact a lot of the different investments and obviously your pensions and Social Security. The big news, of course, over the last few weeks has been the election of Donald Trump to another term. This is obviously going to have a huge impact on the markets. It's going to have a huge impact politically. Normally, it's good to have one party in charge of the presidency and maybe one party in charge of Congress. And this time, it's going to be all three, the Senate, the House, and the presidency, all controlled by the Republicans, which we expect a lot of changes because of this. Some of those changes are going to be positive, some of those may be negative. So we'll take a look and dive into some of the proposals, including the tariffs that Trump is talking about putting on, which is going to be a big deal. But there are some things that we're seeing an immediate reaction. Obviously, the stock market has really jumped up since the Trump election. We've seen stock prices take off, but not everything has gone up. There's actually been kind of four areas that have done very poorly since the Trump election. One has been gold. Gold has come down over $200 an ounce. The reason for this is the expectation is that there's going to be a lot more stability in the markets, maybe less inflation, maybe with Elon Musk and that Vivek Ramaswamy coming in and doing their government efficiency. We'll see gold prices come down. I disagree. I think gold prices will continue to go higher. We are going to see a pullback. My target originally on 2024 was actually 25.80 for gold at the beginning of the year when it was only 2,000, which was a big deal. You know, going all the way from 2,000 to 2,500 was going to be a big run. We actually got all the way up almost to 2,800. It's now, of course, pulled back to 2,600s. Now, I expect it to potentially come down a little bit further, but we have some pretty firm support at 25.80. And so with that in mind, I think gold will be $3,000 at some point next year. So we want to keep those positions on. Inflation is going to be a lot worse than everyone thinks. Trump is going to have to spend money in order to accomplish some of the things he's going to want to accomplish. And certain things he's going to do, like tariffs, for example, could be very inflationary. So we'll talk about that a little bit later in the video. Some other things that have been impacted, obviously oil prices have kind of stagnated, actually come down a little bit. They bounced around. The reason that oil prices are not doing so well with the Trump presidency is because of his whole drill mantra that he's been putting out there on the campaign trail. And the idea is if you drill a lot more oil, then of course oil prices are going to come down. And I don't think this is actually going to be accurate. Oil prices are set globally by demand around the world. And I think there's a huge demand, especially with artificial intelligence coming. All these data centers are using a lot of electricity, and a lot of natural gas and oil is used to supply that electricity. And so they're even talking about opening up nuclear power plants. Microsoft's talking about reopening 3 Mile Island, which I didn't think I'd hear that in my lifetime, but that is on the table. But a lot of these nuclear power plants are actually going to take a long time. There's a lot of red tape to get a nuclear power plant off the ground. In fact, I think Facebook was working on one, and it's been completely canceled due to a rare bee. There's a bee that would be impacted by this nuclear power plant, so that has been shelved because of that. So obviously gold and oil, I think, will recover. I think the initial drop in those is unfounded, and we'll see a resurgence in gold and oil prices going forward. So hang on there. The other two that have been impacted, which I think are going to be permanent impact, is big pharma and big agriculture. These, I think, are definitely going to be in for some downturn. Obviously, the stocks of these companies have been impacted quite a bit. And the big news there is Robert F. Kennedy Jr. and Trump putting him in charge of Health and Human Services. This is a big deal there in the government. He's talking about banning a lot of things in our food that are banned in Europe already, but he's talking about having these same things that could have adverse health consequences. These same kind of products are going to be banned here in the United States. They're also talking about having a lot more look at all the pharmaceuticals and all the drugs and the vaccines that are out there, and also having some of these companies maybe have some liability again in creating vaccines and drugs, which obviously is a very big negative for big pharma and big agriculture, which will see the brunt of that. And that's something that I think will continue throughout Trump's presidency. So those are areas we definitely want to watch out for. I don't think you'll see a recovery in those like you will with gold and oil. So one of the other reasons that I think that Trump is going to have a harder time with delivering on some of his promises is the data going into the election has been pretty rough. In fact, if you look at the jobs data, we were expecting last month 250,000 new jobs, and of course that was revised down to 125,000 expectation because of the hurricanes and the labor disputes and the strikes, but we got 12,000. That is a big drop. And not only did we get a 12,000 job increase, which was far less than we expected, but we actually saw 112,000 revision to the prior 2 months. And that was after, of course, the big revision we already talked about, which was the 818,000 job revision, which we saw in August. That was for the whole previous year. So this is a lot of revisions in the job numbers. It does not look good. When you start looking at this jobs data and you look at what was going into the election, I think there may be a little bit of a hangover after all of this initial surge in the stock market with the Trump election is over, because the data just does not look nearly as good as everyone seems to be making out at this point. The other data that we got is the GDP, or gross domestic production. This data is what kind of tells you what the economy is doing, how it's growing. It came in at 2.8%, which would be okay, but the problem is personal consumption expenditures, which came in at 3.7%. It just looks like there is too much fraud going on, in my opinion, in the data. You look at a 2.8% GDP and it sounds, oh, this sounds great. But the problem is the government uses something called a deflator, and this is what they assume inflation is. And so how this works is, let's say the government says inflation is 3% and the GDP comes in at 6%. Well, they'll use a deflator and say, okay, the GDP is 3%, 6 minus 3. Well, they do that when they're calculating this 2.8%. The problem is if they undercount inflation, if they say inflation is a certain amount and it's actually 2.8% higher, well, then the GDP actually came in at 0. It didn't come in at all. And so these numbers, I think, are very suspect. And so when we look at these, I think the GDP numbers, which came in okay, is something we really have to dive in a little bit deeper and understand how it's calculated and whether or not this gross domestic product is actually a good number. So looking at this data, why is the stock market continuing to go up? Why is everyone saying the economy is great and the market's up when we see a lot of this bad economic data? And what it boils down to is liquidity. See, the government and the Federal Reserve is providing a lot of liquidity, and they have been for the last really 2 years, providing a lot of liquidity for the markets, which keeps up asset prices, keeps stocks up. This is good for people that own assets, people that own stocks and real estate. It continues to go up. It's not so great for someone who does not own assets, who just gets the higher bills at the grocery store when you see a lot of the inflation kick in. And so where the money is coming from is several places. One area is called the reverse repo market. This is actually a liquidity funding tool that the Federal Reserve uses to create more liquidity in the market. And if you go back to January of 2023, we were at $2.5 trillion in that funding program, and we're now down to $150 billion. I talked about this in a previous video, how I thought they would probably spin down the reverse repo market in order to keep a lot of liquidity in the system, but there's not a whole lot left. You go from $2.5 trillion down to $150 billion, and I think that we're at the point where there's not a lot left. What are they going to do after this? I don't know. They're going to have to probably come up with some kind of quantitative easing or some other Federal Reserve program to increase liquidity. But as it stands right now, they've kind of run through that reverse repo market. The other liquidity that the government is providing the market is one that no one seems to be talking about. I've not heard this anywhere, but I've dived into the details and I can actually see where it's coming from. And it's really interesting. They're called treasury buybacks. And when I first started looking into this, I thought, okay, this is a small amount of money. It's not going to have a huge impact, but it turns out it's a lot bigger than I've thought. In fact, if you go back to January of 2023, over less than 2 years, Janet Yellen has managed to reduce the overall maturity on all of the treasuries that are out there in the marketplace. They've been able to reduce it by 1.2 years. That is a huge reduction. So what is a treasury buyback? How does it work? Well, what it is the government is actually taking on additional new debt in order to buy back older debt. So, for example, if the government needs a certain amount of money to fund current operations, they'll issue short-term treasuries in order to fund that, and then they'll issue additional short-term treasuries in order to fund buying back older treasuries. So this is very similar to if you had a mortgage on your house, and the mortgage on your house was, say, 3% fixed. It would be like you taking out a variable rate mortgage, maybe a line of credit at, say, 5%, and it's variable rate, and you're going to use that money on the 5% variable rate to pay off your 3% fixed rate mortgage. Well, that sounds crazy. Who would do that? Well, the government. So this is what's going on. They're actually creating a lot more additional liquidity in order to buy back those fixed rates. Now, this sounds like crazy. Why would they do that? They're saddling all these additional interest charges on the government in the future. That is true. But what's interesting is they're able to buy back those older treasuries at a discount. So it'd be like you being able to pay off your older mortgage at a reduced principal amount because the interest rate on your older mortgage is lower than the current market rates. So this is what we're seeing. The government is able to buy back this debt. They're able to make the difference on the spread, which creates more liquidity, creates more money, so the government can spend more money and not really report it on their books, because if you issue $100 billion and you're able to buy $70 billion of cash to buy $100 billion worth of treasuries from the past, you basically make the $30 billion spread. So this is a big deal. No one seems to be talking about treasury buybacks and how it actually works. And so I want you to understand that this market is something that it doesn't have a whole lot left. When you manage to reduce the 1.2 year maturity on all these treasury buybacks, there's not a whole lot left. We've taken all the longer duration and we've moved it already to the shorter duration. Everything's being funded now in the shorter duration. And it's interesting where this money is coming from. It's all the people that have their money in bank accounts and money market accounts. Of course, now you can get 5%. Well, that's because the Federal Reserve and the Treasury, they're issuing all this new additional debt at a very, very high interest rate compared to the old debt. And they're able to take that new debt at the higher rates and buy back the old debt from the Federal Reserve and from the marketplace. And so you're in a position where the government, yes, is going to have to pay a lot more in interest in the future, but it's creating a lot of liquidity now. I just don't know how much more is left in this. And so this is something to really watch out for. If this dries up and they're not able to do a lot more of these treasury buybacks, obviously this could have a real negative impact on the economy and liquidity, which could cause a downturn in the economy. So this brings up a lot of problems with interest expenses. And the government actually has to spend now $1 trillion a year just to pay interest on the national debt. And with these treasury buybacks and everything we're seeing going forward, that number is going to grow to 1.5 trillion in a very short period of time. But it's not just the government. We also have what is being called the corporate debt wall. These are corporations that actually have a lot of debt that they are paying at lower interest rates, and they actually are going to have to refinance a lot of that debt at much higher rates. That corporate debt wall kind of hits in 2026 and 2027. So this is a real concern. There are a lot of companies that are out there that may not survive with these refinance of debt. The government may have to intervene. We may have to do some quantitative easing in order to shield some of these companies, or we'll just see a lot of bankruptcies in the corporate world. So this is called the corporate debt wall, which is obviously a concern that we're seeing in the markets. And when you start totaling up all of these potential issues and the data, this is why I think we may have a little bit of a hangover from this initial reaction to the Trump election and the stock market really spiking up. We may see a hangover here shortly when you start to really dive into all of this data. So let's talk about tariffs. Trump won the election. And what does that mean? Everyone's talking about tariffs and how this is going to change the economy for the good or for the bad. And so let's talk about what tariffs are and what the impact of tariffs are on the economy and you. So what a tariff is a tax. It's a tax on foreign-made goods. Don't let these politicians fool you with, China's going to pay the tariffs or Mexico pays the tariffs. That's absolute baloney. The American people pay the tariffs. And so it's essentially a sales tax on foreign-made goods. Now, you don't pay it as a consumer at the sales tax level. It's paid by the actual importers that are bringing things into the United States. But ultimately, the result is you pay higher prices for foreign-made goods. So, looking at how this works, I'm going to use an example, analogy I've come up with. Let's say that you have a bucket that's made in China at Home Depot, and that bucket costs $5. Well, the problem is the U.S. companies, if they were to make buckets, they would have to charge $7 in order to be profitable. So essentially, at a $5 bucket, U.S. companies cannot be profitable at $5. They're just going to go out of business. And so that's what's happened. There's no buckets being manufactured in the United States because no company can make a profit selling $5 buckets. So if the president increases the tariff, let's say he's talking about 100% on Chinese made goods, $5 buckets become $10 buckets. That's a 100% tariff. Well, now all of a sudden, the U.S. company at $7 can now be profitable. They're going to make a profit. They're going to be able to sell buckets for $7. And now we've created jobs in the United States. Now you have a job with someone that's making buckets. And so now everything's great. We have a stronger economy. But wait a minute. Here's how it works. So yes, now we have a potential stronger economy. We have jobs here in the U.S. because we're making $7 buckets. Well, now some people might say, well, wait a minute, Matt. These American companies are going to get lazy, and now they're going to raise the price of buckets to $9 because, hey, the Chinese are at $10. They're going to make lots and lots of profits. Well, that's someone who does not have a basic understanding of economics, because there's no limit on the number of bucket manufacturers in the United States. So if someone comes out with a bucket at $9 because the Chinese bucket is $10, well, another company will come out and make an $8 bucket and then a $7. And eventually the price goes down to whatever the price needs to be for the company to be profitable and still sell buckets at the cheapest price possible. That's how capitalism works. And so very simple, they're going to sell $7 buckets in a very short period of time. Now, the problem is with this whole thing is, yes, we've created jobs in the US, everything's strong, we got a better manufacturing base, but we're all paying $7 for buckets, right? We were paying $5 for buckets previously, and now we're paying $7 for the bucket. And so you got to understand that tariffs in the short run are very inflationary. They're going to cause prices of foreign-made goods to go up. Those have to be replaced with US made buckets that are going to cost more. And this goes along too with all this that Trump's talk about removing all of the illegal immigrants from this country. And there's a lot of them. Officially, it's like 11 million came in under Biden and potentially 20 million, some of the reports say. If you round up all these people and you send them out of this country, there's a lot of jobs in the United States that Americans will not do at the wages that the illegal immigrants are getting paid. So these are maybe people in kitchens. These may be people that are, maintenance workers, janitors, people that are making a wage that's below what a U.S. citizen would be willing to work that job. Well, that means that wages have to go up. In other words, those companies that are hiring these people, they're going to have to replace those jobs with a higher pay U.S. worker. And so because they're paying higher wages, now you might say that's good. Now the American workers are getting more wages. Everything's great, the economy. But wait a minute. Now all of a sudden those companies have to pass those higher wages on in their products. And so it's just an expense. It's an expense for that company. So you're going to raise the price of their products to offset the higher cost of labor. So this is no different. The tariffs are a higher cost. The labor is a higher cost. So in the long run, some of these policies may be beneficial to U.S. workers and U.S. jobs. We may be able to have a stronger manufacturing base. So this is a long-term, potentially positive thing for the U.S. And this goes back to the original Hamiltonian plan, American plan, where you have, protect U.S. jobs, the higher paid manufacturing jobs, build the economy, grow it, have high tariffs on foreign-made goods. And this is how the U.S. actually built a pretty strong economy. And of course, over the last few decades, a lot of those tariffs have gone away. There's been a lot of different free trade, which actually isn't free trade, it's managed trade agreements that have been put in place. But ultimately, when you start putting these tariffs on in the short term, there is going to be a lot of pain. And so we have to be prepared for that on the investments and on the economic data that we see as a result of this. One of the things that we are watching that's coming up is the debt ceiling, which is going to hit right around January the 2nd. And so this is when the government actually hits their ceiling on the amount of debt that the government is allowed to accrue. And so we're going to need to have Congress and everyone get together to approve an increase in the debt ceiling. And of course, with the recent election, there may be some pushback from the Democrat side of the aisle on being able to extend this debt ceiling. The Republicans did this many, many times in the past when they were trying to pass a debt ceiling increase. There would be a lot of Republicans that would try to prevent this debt ceiling from being increased and try to negotiate. We may see the same thing from the Democrats. That's yet to be seen. But I do think that January 2nd is a potential issue as far as the debt ceiling being hit. And of course, with Trump getting ready to take office, this could throw a lot of cold water on some of the initial plans that Trump wants to put in place because of this potential debt ceiling. So we'll see how that plays out, but it is something I'm definitely watching going forward come January the 2nd. So how do we position all of the investments in light of the election and some of the data that we're seeing? And it's very similar to what we've been doing, which has been very, very successful. We want to focus on high quality stocks, high quality dividends, free cash flow, companies that have good valuations. And so that is really the focus in this current market, current environment, which we see to be a bit volatile, especially coming up with inauguration and everything else. We'll see probably the VIX index spike up and bounce around during this time. And of course, we're already seeing the MOVE index, which is the Treasury index, bounce around. A lot of that has to do with what we're seeing with the debt markets and interest rates. And so we'll keep an eye on that. One of the areas that always is a good area, it's been a great return for us in the past, is the buffered index portfolios. And this is where you can invest just in the S&P 500 in one of the stock market indexes, and you get a great potential return with some insurance against risk. And now is an ideal time to do that, especially with what we're seeing. Is the momentum going to carry forward? is Elon Musk and Vivek Ramaswamy, are they going to be successful at reducing the government, cutting the red tape, allowing growth to happen? I'm not really confident because the politicians oftentimes promise all kinds of things during the campaign and then they ultimately can't deliver for whatever reason when they get into office. We'll see how that plays out. But at the end of the day, this buffered index portfolio, the current one that we just got, is really good. I'm glad that we waited. I was waiting to invest some of our clients for this new one coming because I thought we'd get a better cap rate, and we have. So we have a 2-year index. It's on the S&P 500. It's got an 18.9% cap, which is a lot better than the 17.6% cap we had last time. And it has a 20% dual directional insurance policy. So it's very simple. If the stock market goes up, you can make up to 18.9%. If the stock market drops, you actually make the inverse return down to 20. So if the market's down 10, not only do you not lose, you make 10%. If it's down 18%, not only do you not lose, you make 18%. And of course, if it's down more than 20%, you just get a 20% reimbursement. So if the market was down 25%, you'd get reimbursed 20, you'd still be down 5%. So this is a great way to invest in the stock market with some great protection on the accounts. In addition to that, the 5.25% MYGA is still being held. They told us that they would hold it until the election, and now we've had the election and it's still available. So I think a lot of the cap rates, interest rates have probably continued to do well going forward with the election of Donald Trump. So that 5.25% is still available. I don't know how long that's going to last. A lot of what's going on in the interest rate markets has to do with the Fed and the Treasury Department and what they're doing. So for now, it's available. We have that on a 3-year and a 5-year, which is a great interest rate on a guaranteed, can't lose insured interest rate. It's a great way to invest some money just to make sure you're protected, and so that is still available. In addition to that, we're investing obviously in a lot of the recession protected investments, a lot of the inflation protected investments, which are all the same. We like gold. I know the price has come down quite a bit since the election, but I think that will rebound into next year. It doesn't go up forever, so it's been on a tear in 2024. We're just seeing a little bit of a pullback on gold. Oil's the same thing. I think energy prices will come back up, especially as we start to need more and more energy with everything that's going on with the data centers and AI and everything else. Long term, we're going to need a lot more energy. So I think that's going to be a great investment. Real estate's a great investment, especially some of the real estate that's providing a lot of free cash flow. Now, I'm not a big fan right now of single family homes and condos. We're starting to see those roll over a little bit. Even here in San Diego, things are really sitting on the market a long time. They're not selling. And this is typically what happens when we start to see the beginning of a downturn. I don't predict home prices to drop like they did in 2008. Obviously, because we had a lot of foreclosures back then. A lot of foreclosures hit the market, which caused prices to really drop. I don't think we'll see that this time. I think what we'll do is we'll see maybe a 10 or 15% drop potentially, but we may not even get that. If we have an increase in inflation and the money supply and liquidity, we might just stagnate with home prices for a while. But in the commercial side, apartment buildings, storage units, assisted living facilities, we're seeing some great cash on cash yield. Obviously, this is really beneficial for people doing 1031 exchanges, and also some of the income funds and real estate that are out there. Those are really, really strong investments. So we're going to hang on to all of our inflation protected investments. I think we're going to continue to do well going forward. Obviously, the accounts have done very, very well this year. And even with the recent drop in gold and some of the flatlining in energy prices, we're still producing really, really good returns. So thank you for watching. If you made it through all the way, I appreciate it. I know it's been a long time since I got a market update out, and I know a lot of you were asking for it, so I apologize it took so long. I've just been running around here with my hair on fire, getting everything done as far as the Roth conversions and some of the tax reduction stuff we're doing towards the end of the year. And even today, this video was recorded over the course of the day between appointments, and so it took us from early in the morning all the way until the evening to get all of the video completed. So I hope it was a good one. If you have any questions, please feel free to reach out to us. You can email us at support@copleyfg.com. Obviously, give us a call at the office, 619-294-6000. We're happy to help you. And if you come into the office, I hope to see you in our Mission Valley office very, very soon.